Here are your top 3 real estate stories for the second week of August. USA core inflation is climbing, job figures are crumbling, and the Fed may be forced into a seismic rate cut. Meanwhile, homeowners are cashing out record equity, and Canada's housing market braces for a steep slowdown. Here's what's unfolding right now. South of the border, inflation is proving sticky. Core US CPI rose 0.3% in July and sits 3.1% higher than a year ago. Combine that with weakening job numbers, and markets are betting almost entirely on a September Federal Reserve rate cut. Why does this matter in Canada? Because when the Fed moves, it influences global bond markets, and Canadian yields often follow. If the Fed cuts, we could see downward pressure on Canadian bond yields, which in turn may lead to lower fixed rate mortgages here. But here's the flip side. A weaker US dollar from aggressive Fed cuts could push the Bank of Canada to tread more carefully, especially if it stirs inflation pressures at home. For Canadian mortgage holders, this fall could bring rate relief, but the timing and size will depend not just on Ottawa, but on Washington too. Canadian homeowners are tapping their increasingly valuable home equity at levels we have not seen in years. In Q2 of this year, cash out refinances reached a nearly 3-year high. On average, homeowners withdrew $94,000, but it came with a cost. Monthly payments rose by $590 and interest rates climbed by 1.45 percentage points. To qualify, homeowners typically needed at least 20% equity, a minimum 6-month ownership window, and good credit. There are mainly 2 reasons why we're seeing Canadian borrowers want to partake in these refinances. Number 1, interest rates have gone up drastically. So you see a lot of homeowners who are trying to keep their monthly payments similar to what they had when they had really low interest rates. So in order to do that, they need to extend the amortization. The other thing is folks have accumulated a lot of debt. And so by consolidating that debt into a refinance, they're often able to generate a smaller monthly payment, which gives them better cash flow per month. Keeping in mind, refinances should be done cautiously because you are adding larger amounts of debt onto your mortgage and oftentimes extending the time that it takes to pay that loan off. But as I said, if you can increase that cash flow and stay in your property and be more comfortable, in a lot of cases, it makes sense. And lastly, Canada's housing market is cooling. Home resale volumes are expected to drop 3.5% this year, down 467,100 units. That pullback is largely concentrated in Ontario and BC, where values and inventories remain pressured. But don't write off the rebound. Analysts at RBC forecast a strong 7.9% bounce in 2026, bringing resale above 500,000 units. So what we're seeing now is a dip, but signs of a slow, gradual recovery are emerging. The next 12 months could be make or break for the market momentum. If you enjoyed this video, please consider subscribing to stay up to date with the latest Canadian real estate content. If you liked this video, you're gonna love this one as well.